Hello, my name is Julia and this is Fix My Finance. In today's video, we will be talking about different options of tax advantage investing to get to financial independence. Specifically, we will be comparing ISAs or individual savings accounts with pension plans. Both of these schemes offer tax advantages at different times of the investment process, and which one is right for you will depend on your specific circumstances and the age at which you're planning to retire. So, let's get into the detail and let's fix some finances. Both ISAs and pension plans allow for tax-free investment gains and can therefore act as tax wrappers. Both of these schemes are not subject to any capital gains or dividend tax and can therefore save you considerable sums of money over the investment lifetime. However, there are distinct differences between these two schemes. The first difference between ISAs and pension plans has to do with when you get the tax benefits. With an ISA, you're investing your net income, meaning you've already paid your income tax. However, any capital gains made on your investments are completely tax-free, forever. With a pension, you get tax relief up front, meaning you don't have to pay any income tax on the amount of money that you invest into your pension plan. The government essentially refunds you your income tax on your pension contribution. So, for basic rate taxpayers, if you want to contribute £100 to your pension, you only need to put up £80, as you can claim back 20% or £20 from the government. Similarly, for higher rate taxpayers, you only have to put up £60 and you can claim back 40% or £40 from the government to contribute a total of £100 to your pension. So at the point of investing, pensions are completely tax-free. This means that your pension portfolio is likely to grow at a faster rate than an ISA because you can contribute a higher base. This increased contribution is at least partly offset by making withdrawals later down the line. For pensions, 25% are tax-free, whilst the remaining 75% of withdrawals are subject to income tax. In most cases, however, this will be at a lower marginal tax rate than your current one, as you're more likely to become a basic rate taxpayer when you are a pensioner. On the flip side, ISA withdrawals are completely tax-free, forever. The second difference between ISAs and pension plans is the annual contribution limit. Pensions have a very generous annual contribution limit of up to 100% of your earnings, subject to a maximum cap of £40,000 per year. This is exactly double the ISA annual contribution limit of £20,000 per year. More importantly, many employers offer their employees generous matched pension contribution schemes, by which they basically pledge to match any contributions that an employee makes up to a certain limit, for example, 6% of your annual salary. If your employer offers such a scheme, it makes sense for you to contribute up to this amount, as you're getting free money from your employer. The third key difference between an ISA and a pension plan is the accessibility of your funds. With a pension, the earliest time at which you can access your funds is the age of 55, or when you retire thereafter. With ISAs, you can withdraw and access your funds at any point in time after investing. This may be particularly relevant to younger investors who may not be as sure about their financial future. Also, if you're planning to buy a house or car down the line and you're planning to use your savings as a down payment, an ISA may be more beneficial for you. So where does this leave us? As you can probably tell by now, both schemes have various advantages and disadvantages. Personally, I am a strong proponent of using a stocks and shares ISA to grow your wealth by investing in the stock market. Especially if you're planning to retire before the age of 55, this gives you the flexibility of doing so. If your employer does offer a pension contribution scheme and match your contributions up to a certain point, I recommend contributing to an employer pension scheme as well. By using both an ISA and your pension scheme, you have funds that you can access at any point in time, whilst also taking advantage of the tax gains through your employment pension scheme. I hope this video was helpful in explaining the difference between an ISA and a pension plan. If you learned something new today, please give the video a like, share and subscribe for more content. Please leave any questions in the comment section down below and I will see you here next time, when it's time to fix some finances.